QuickBooks Pro Desktop 2021. Multiple currencies, cash, accounts receivable, and accounts payable. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are on the desktop. We have our QuickBooks file on the left. We have the QBW file that we created last time on the right. We're going to be double clicking on the QBW this time. That'll open up the program and the file within it. You can also then open up the program and then open up the file within it either way. I'm going to double click this time on the QBW file. Here we are in our practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. We now want to discuss some of the components or uses of the multiple currencies. So we turned on the multiple currencies last time. You'll recall that you do so by going to the edit dropdown, then down to the preferences. You want to go to the multiple currencies tab on the left and then the company preferences on the right. If you had not turned them on, there'll be a little yes icon here to turn them on. Remember that once they are on, you can't turn them off. So make sure to read the default instructions and whatnot before turning it on. That's why, of course, we set up a test file here. If you do turn it on in one file, it should not affect then your other company file. So if you turn it on in your test file here, it shouldn't affect another company file. So I'm going to close this back out. Once we have the multiple currencies on, we can then go into the lists and we should see the currencies lists. So now we have the currency list, which will now be available to us, and we have all the currencies here. Notice that the include inactive items is now checked off. So all the ones with a little X on them are inactive. If we wanted to make them active, we can simply choose the currency, right click, and then we would make them active. And that'll take the little check off right there. We can sort them by this column, or we can sort them by code, if that would be easier to sort them by to find the currency that you are looking for. Once you have found those currencies, then I would basically uncheck this item down below so we do not see the inactive items and only the currencies that we will be dealing with. So we're going to be looking mainly with the US dollar and the Canadian dollar. I'm going to close out this item again, and you can then make them inactive this way by going to right click on it, make inactive. It no longer will appear. We didn't delete it. It'll still be there. If I check this off again, we can then find it once again. So let's just do a recap of what it means to be using multiple currencies, how multiple currencies are going to work, and then which accounts are going to be affected, which will include the accounts receivable possibly, the accounts payable possibly, and then the cash accounts possibly, and then the customers and the vendors that would be related to the receivables and the payables. So remember that you're always thinking about your financial statements as of one measuring tool, meaning one type of currency. So in our case, that's the US dollar. So in our case, we're measuring our financial statements in the US dollar. So when I put like the accounts receivable on the books or cash on the books or anything, if I put like equipment on the books, then I'm measuring it in terms of US dollars. So for example, if I put inventory on the books, I'm not putting it on the books for 10 units of inventory. I have to measure it in the unit of US dollars. And so those say that those 10 units of inventories are now worth so many US dollars, whatever that might be. The same is going to be true if we think about it with these other currencies. It gets a little bit confusing with other currencies because we start to think, hey, this other currency is also a measuring tool. If I have a bank account with Canadian dollars in it, Canadian dollars is like another ruler. It's like cash. It's like another type of ruler in it. So our mind gets a little mixed up in terms of, well, how do I measure like another ruler? Well, we have to measure the other ruler with our ruler. We still have to measure it in dollars. So if we have 10 units of Canadian dollars, $10 in Canadian dollars, instead of 10 inventory units, we still have to value them in terms of US dollars. So it's just like anything else from that perspective. If whatever currency we are in, all other things that are in other currencies, we need to measure in US dollars. What will that typically be? Cash, because obviously if we're holding on to cash in another currency, then we have physical like other currency that we can value in our dollars. And then we also might have things that we're going to be receiving in the future, which are in other currencies, receivables. In other words, people are going to pay us in the future, but not in our currency, not in dollars, but in something other than dollars, say Canadian dollars. That means that we have to value our receivable then somehow in terms of the Canadian dollars, because that's what we're going to be receiving. And then, of course, the payable, same thing. We could be paying something in the future, but instead of paying in US dollars, we're going to be paying in something other than US dollars. So we have to measure it on our financial statements. We got to remeasure the payable in some other type of currency. So if we were taking a look, we'll look at a practice problem in Excel and kind of work along the practice problem as we go as well. But notice if you look at a trial balance here, and we just said that we had so many units of, say, Canadian dollars on the books, this amount on our trial balance or on our balance sheet is not going to be so many Canadian dollars, because just like it wouldn't be so many units of inventory. It's going to be so many dollars worth of the Canadian dollars we're holding. We're revaluing the units of Canadian dollars to US dollars and then putting them on the books as the value in the US dollars. Then we also have, like, that would be the same if we had like inventory. Obviously, again, we're putting it on the books on how much the dollar amount of inventory is, not how many units we have of the inventory. So that'll be the same with the payable here. If we have a payable and we're paying something in foreign currency units, we're not going to put the payable in foreign currency units, even though we're going to be paying in foreign currency units. We have to revalue what we're going to pay in US dollars. And the same is going to be true with any receivables that we have on the books. That's why those are the three accounts that you want to think of most when dealing with foreign currencies. If you're making sales to people and your accounts receivable are going to pay you in foreign currencies, then you got to deal with the foreign currencies, because you're going to have to revalue the receivables and whatnot, and the money that you're going to be getting, the cash that you're going to be getting in foreign currency. If you're going to be paying somebody in foreign currency, then you got to deal with the foreign currency items as well. Now notice there's also an added kind of issue here, because if we were talking about something like machinery, for example, we put it on the books not at how many units of machinery, not how many forklifts we have, for example. We put it on the books in terms of cash. But the machinery doesn't change over time, so oftentimes we're going to use more of a historical cost and may not be revaluing it, at least under generally accepted accounting principles, because it doesn't change. I don't know what the new value is, so I'm not going to revalue it all the time. But the relationship between our currency, the dollar, our measuring tool, our ruler, and whatever other currency that is out there, that exchange rate is known all the time because it's a market exchange rate. It's similar to having securities on the market. When you're talking about publicly traded securities, you can then revalue your securities to the current market value easily, because the market value is trading currently, and your securities, your stocks, for example, are exactly the same as all other stocks. So whatever they are currently selling for on the market can give you a good idea, give you the market value. The same is going to be true with currency. Currency is trading all the time. So it's kind of similar to like owning stocks, where basically you always have a market that you can look at and say, well, if they're publicly traded stocks, I know what they're currently trading at because I can look at it. And the same is true with the currencies. So that means that the currency is always changing, and we can always update our currencies and need to be updating the currencies periodically. So that means that if I'm holding on to Canadian dollars today, periodically, typically at the end of the month or when we make financial statements, end of the month or year, we're going to need to revalue our investment in the foreign currency, even if we're just sitting on it, even if we're just holding it and we're not like spending it or whatnot. And the same is true for the receivables and whatnot. We're going to have to revalue them in a similar way as we would have to revalue our currencies or our investments in, say, stocks to the market value, possibly periodically, depending on how we have those on the books as well. So that means if I go back to QuickBooks and then I think about the accounts that will be affected, if I go to the lists drop down and we go then to the chart of accounts, so we have these limited amount of accounts up here. These items, you can see they're listed here in the currencies as the US dollar, which is the default dollar. Some of the major currencies that will then be affected are going to be the accounts receivable, the accounts payable, and cash. So I have an accounts receivable set up by default in US dollars. We would then need to set up another account for accounts receivable if we're going to be having accounts receivable that we're going to be getting in foreign currency, say Canadian dollars. So to set that up, we would go to the accounts receivable dropdown. We're going to say new account, and I'm going to make this a receivable as well. It's going to be an accounts receivable account. I'm going to continue with it, and then I'm just going to call it accounts receivable, and it's going to be in Canadian dollars. So I'm going to hit the drop down. Here's this line item in US dollars and Canadian will only be there if you have multiple currencies on and only for certain accounts. If it doesn't impact an account, then it typically won't be there. If I just add an expense account, then it's just going to go to the default of US dollars, and we're not going to have this valuation there typically. So I'm going to say this is going to be in Canadian dollars. I'm just going to call it accounts receivable, and then I'm going to say CAD for the Canadian dollars, and that should match basically the code that's going to be over here. That's how I would set it up. But the bottom line is it needs to be labeled for Canadian dollars, and then labeled down here as the currency related to it. We can then save that, and now we've got a receivable saying, hey, look, I'm going to get this money in Canadian dollars. That means that when I set something up and a receivable customer is going to pay us in Canadian dollars, we're going to have to revalue that receivable on our books somehow and account for any basically gains and losses on it. And we'll see that in future presentations. The same will be due for accounts payable. So the accounts payable we'll have in US dollars. We want to set one up for in our case, Canadian dollars. So I'm going to say new. And the other account that'll typically be affected if I hit the drop down is going to be the accounts payable. So I'm going to say drop down accounts payable and continue. And I'll do the same thing. I'm going to make this Canadian dollars instead of US dollars so that we have to deal with that exchange. That doesn't mean that I'm going to put this on the books in Canadian dollars. That means that QuickBooks is going to help me to value the Canadian dollar receivables that I'm going to be paying in this case in Canadian dollars in the future. It's going to allow me to do that exchange to report it on our books as measured in US dollars. So it's going to help us to do that measurement process. So we have the accounts payable, and that's going to be CAD. So CAD. And so we have that. I'm going to say save and close. So that's the other account. And then, of course, we'd have a cash account. We'd need a checking account. I'm going to set one up both in terms of US dollars and then one in the Canadian dollars. So I'm going to say accounts, new accounts. This one's going to be a cash account or bank account. I'll set up, and we'll say continue, bank account. I'm going to set one up. It's just going to be the checking account, checking. And this one, again, we have the drop down here. You can see we got the drop down. I'm going to say this is USD. So US dollar, US dollar. I might just put US sometimes, but maybe that's bias or something. I don't know. US dollar. So I'm going to say that there. And then I'm going to open another one and say save and new. And then now I have another bank account, drop down bank account, and I'm going to say this is checking, and this is going to be for the Canadian dollar. So now this is going to be for the Canadian dollar, and we will use other examples of currency. The Canadian dollar can actually be a little bit confusing because there's a lot of interplay between U.S. and Canada, our neighbors. So clearly that would be an applicable point. But they're both called dollars, so that could be a little bit confusing. We'll use some other currencies as well. So this is going to be then the CAD. So checking, I'm going to say CAD, and that's it. So I'm going to say save and close. Now let's just set up another account, like an expense account, just to see basically the difference here. But I'm going to set up another kind of a general expense account, a new item, and let's just think of a normal kind of expense account here. And we're going to say then, if I set up like utilities or something, utilities, then notice we don't have the foreign currency thing. It's not there. It's not an option because it's going to be set up as just the default that we're typically going to be recording it in US dollars. So notice we just don't have that option there. So if I set that up, we don't have something to add. It's going to be by default then in the US dollars. Now that we have this set up, let's go back to the home page and see how this would affect. So I'm going to go to the home page in the open windows, our normal flow type processes. So let's think down here in our customer type of transactions then first. So we might then have an invoice. Remember, when we make an invoice, that would mean that accounts receivable goes up. The other side would then go to sales. When we create the invoice then, if I open up the invoice, we will have to determine whether or not we're going to get paid in the future in US dollars or in some type of foreign currency. That means that when we set up the customer, that's how that will be done. When we set up the customer, we're going to have to set up the customer as one who pays us in either our currency or some other foreign currency. So when we set up the customers, then that's what's going to be driving the accounts receivable that will then be hit. When we set up the accounts receivable, we then want it to go to the accounts receivable in the Canadian dollars. This one will then have to line up. The accounts receivable account here will have to line up with the customer that we set up in terms of the currency preference. And then we can move forward, and that'll then be calculated in the accounts receivable for the foreign currency, which we can then value in US dollars on the financial statements so that we could see them in terms of how they would be valued there. We would then receive the payment. We'd have to record whether we want it to go into undeposited funds or directly into a checking account. If it goes into a checking account, which account is it going to go to? And then we would have to record the deposit. And as we record the deposit, we could think about the account that's going to be hit on the deposit side of things. Is it going to go into the US or Canadian checking account based on the currency that we will be receiving there as well? We'd have a similar process with the sales receipt. So if I entered a sales receipt, that would simply mean that we got paid at the same point in time. So we would then have to set up our customer, lining up the customer to the proper currency that we will then be using as well. Closing this back out. Then on the payable side of things, when we enter a bill, if I was to enter a bill for a payable, if I was to pay the bill in the future in foreign currency, I'm going to pay it in foreign currency in the future. The accounts payable that will result from the bill that we create will have to be in foreign currency. And that means how will the system know that? Well, we have the drop down here for the accounts payable foreign currency would need to line up with the vendor. So when we set up the vendor, we'd have to set it up for a foreign currency vendor, and those two things would have to line up once again. Then the accounts payable would go up, that it would be a foreign currency accounts payable that we would have to value with the exchange rate in the current to our currency, right? We would have to value it in US dollars, and then we would pay it, and we would pay it with our pay bill function over here. We can also use the write check, which would be going directly out of our account, writing the check either to the US or the foreign account in this format as well. So closing this back out, we can also see the vendors and the customers that would be set up that once again would need to be set up in terms of their preferred currency. So if I go to the customer dropdown and we take a look at the customer center, and we can add a customer as we go, or we can add them here in the customer center. So let's add a customer and say I want to say a new customer. And I'm just going to call it customer one, and this is going to be CAD is going to be the currency we want for that customer. Now, obviously, we wouldn't write CAD possibly, or they wouldn't be named customer one, but we might want, some indication there. But then I'm going to say the currency is going to be in over here, and this item wouldn't be here if we didn't have the foreign currencies turned on. And I'm going to say Canadian dollars. So we're going to say there's our currency there, and there we have it. I'm going to say okay. So then if we went to the invoice now, so if I go to the home page and I made an invoice, then that foreign currency, if I went to that foreign currency, it takes it to the CAD foreign currency, and then it lines it up with the foreign currency receivable, which would need to be then recorded along with it so that our foreign currency receivable would go up. Let's close that back out. I'm going to say no, I'm not going to record it. I'm going to do the same thing for the vendor side. Let's hit the vendor drop down, vendor center, and think about the vendor side. I could set up a vendor once again that we're going to be paying. Now we're going to be paying in foreign currency. We promised to pay not in our currency, but in the foreign currency. So I'm going to set up a vendor. I'm going to call it vendor one CAD. And then I'm going to say it's not a US dollar vendor. We're going to be paying them in foreign currency. So we'll set up the Canadian dollar and then okay. So we have that. And once again, that cell would only be there if we had the foreign currency turned on. Then if we go back to the home page and we were to say, I want to enter a bill, and I want to say the bill is going to be going to the vendor one, then notice it lines up here with the accounts payable vendor. Once again, has to line up with this item, and that means it's going to be increased in the accounts payable with the bill, but the foreign currency one, and then we'll be using the exchange rates to value it in terms of US dollars. So once we have, I'm not going to record that. Once we have these items on the books, once we have, for example, these list of items in foreign currencies, let's go to the lists chart of accounts. And so once I have like a checking account, receivable, and payable possibly in foreign currency on the books, we also may have to revalue them from time to time, possibly at the end of the month or year as the exchange rates change. And QuickBooks has a nice feature to do that. If we go to the foreign currency lists, then I can value these currencies by going to the activities down here. And I'm going to say download the latest exchange rates. So I could say download the latest exchange rates, and that'll give us these exchange rates for us. So they're actually providing the exchange rates for us if we're working in real time. And then I can then say that I would like the activity for you to make to have an adjustment for the currencies. And then this would basically make an adjustment based on these new exchange rates, meaning anything that's in a foreign currency account, like cash in the Canadian dollars and the accounts receivable and the accounts payable that we need to be revaluing to the current amounts, we can then use this feature to make the adjustment basically for us. And so that's a really nice feature that it can pull in these foreign currencies, which are like the spot rate as of this point in time. These are like the latest spot rates that we can have, meaning the exchange rate at this point in time. And we can use that to automatically enter the adjustments to the accounts that are set up in foreign currencies, which is the cash account, the receivable account, and the payable account. Include those items for it and then make that adjustment. So we'll see some examples of that as we work through practice problems in the future. I'm going to work it step by step, one in Excel, so we could see it kind of in an Excel format. You don't have to fill out Excel as we go, but I want to just show you what it would look like in like a really straightforward, just journal entry format, just increase, decrease, and then see how we can use the tools in QuickBooks to automate that process.